Hey all, welcome to ShareTrek. This is Raj here. Today I bring this video to you because I have interesting information that I came across and that can potentially explain why technicals are bullish. It has something to do with the inflation expectations despite the strong employment report. So let's get started. And after that, we'll probably have a look at the indices again and see if it makes any sense. Welcome back, friends. Financial professionals use inflation swaps to manage risks associated with inflation and to take advantage of price fluctuations. This type of a swap is beneficial for various types of institutions, particularly those whose core business involves receiving inflation cash flows, such as utility companies. In an inflation swap, two parties enter into an agreement where one pays a floating payment linked to an inflation rate and receives a fixed rate of interest, while the other pays the inflation-linked payment and receives the fixed interest rate payment. The payments are calculated based on the notional amount. Zero coupon swaps, which involve swapping cash flows only at maturity, are the most common types of inflation swap. Like other swaps, the initial value of an inflation swap is equal to its face value. As interest and inflation rates change, the value of the floating payments of the swap will fluctuate. The market value of the swap is determined at regular intervals, and either party may need to post collateral depending on the value of the swap. It's not like inflation swap guys are clairvoyants and have always got it right, but their track record of predicting inflation is pretty good despite a few misses here and there. Let's now look at the article that prompted me to make this video, and we'll also look at the data. This article comes from a website called MarketWatch. They have some pretty good articles, and I look at them from time to time. And here the heading is Swift and Surprising Drop. Inflation Traders See CPI Rate Falling Towards 2% by June and Staying There. Guys, this is amazing because looking at the way the inflation is right now and the strong employment numbers, I would not have thought that by June of this year, we'd have inflation CPI falling to 2%. So let's read on further what they are saying here. So it says, a counter-argument is developing in financial markets on the most likely path ahead for US inflation, and it's one that would likely come as a big surprise to many investors and policymakers. Of course, it came as a big surprise to me for sure. It's the idea that inflation as measured by the annual headline rate on the consumer price index is set to fall below 3% after the next handful of months and stay in the vicinity of 2% for the entire second half of 2023. Traders of derivative-like instruments known as fixings, who are also seen as the financial market's brightest mind on inflation, are penciling in such a scenario for this year. They have been close to mark on their forecast during the inflation's run-up from 2021 to 2022, though they have also missed several downside surprises. So if they miss the downside surprises, that means they are being very conservative. So we should have a look at what they have in mind. Let's look at the table here. And the way I read it is that by 30th of June 2023, we'll be looking at an inflation rate of 2.57%. And if we look at the fall, it's very steep. 31st of January 2023, they were looking for 6.18. And 28th of February 2023, they are looking for the inflation to fall significantly to 5.77. That will be a big drop. And on 31st of March 2023, it is expected to go down further by 1 point to 4.77. Then a mild decrease in April, and then a slightly bigger decrease in May. And then by 30th of June, we are expected to be at 2.57. And then there are some marginal increases for a couple of months, then a little decrease. And with the lowest inflation CPI being projected on the 31st of October 2023. So friends, if that is the case, and that's what the inflation gurus are looking at, then I think the housing market is going to be going absolutely ballistic come January, and also the pre-construction market, or a market where people buy from builders and all that, that's also going to start jumping up. And especially for people like us in Canada, if this is true of the US, the same is going to matter to Canada as well. So I think the good times are going to come back very fast. This seems too good to be true, but we have to consider everybody's point of view. And if I go down further, they are saying, I'm looking for another 25 basis point Fed rate hike in March, with the rates hike over from there and lower inflation being the big narrative. The inverted yield curve is telling me something severe will happen in the economy. And the recent decline in inflation in countries like India leaves me pretty much confident inflation is going to drop here. And he says people do not want to continue to pay high prices, and there's a real threat that inflation comes down towards 3% handle this year. The notion that inflation could approach levels close to the Fed Reserve's target of 2% within months is one that hasn't been discussed much publicly, not even by central bankers themselves. The consensus view on inflation is that it's likely to remain elevated between 3% and 6% for some time, which will prompt the Fed to keep on increasing interest rate hikes and leave them there, boding poorly for risk assets. Indeed, some traders and strategists are focused on the competing argument that the US could be heading for a period of transitory disinflation in which any improvement in price gains will turn out to be fleeting. And then I saw another paragraph out here which says, behind the counter-argument in favor of a swift, surprising return to more normal pre-pandemic levels of inflation is the view that the US economy won't be able to avoid a recession, and that such a contraction is bound to bring a swift decline in price gains. So I think these are the things that probably are the undercurrents in the market, which is showing us a lot of bullish trends in the technicals. New York Fed President John Williams said the central bank will likely need to keep interest rates high for a few years to kill inflation, while Fed Chairman Jerome Powell said on Tuesday that January's blockbuster job gains underscore the need to keep raising interest rates. Powell said he expects inflation to drop back to around 2% by 2024. So there's a very, very different expectation from the Fed chairman. The Fed chairman is looking at a much longer period of time, whereas these inflation swap guys, they're all looking at 2023, mid-2023. So the divergence is significant, and we don't know who is going to be right. So that's what I wanted to bring to you guys. Well, now that we have had a look at that article and we have an understanding of what the alternate theory is, why don't we have a very, very quick look at our indices, just the indices, and look at it from the point of view of a bullish thesis and see how that could be possible. Let's do that. Well, guys, here we are in our TradingView platform, and we are looking at the NASDAQ futures. And right now, the NASDAQ futures show a negative of minus 0.51%. So NASDAQ futures are bearish. And our bull flag is being used to support a downward movement. We are having more of lower lows. But if we take a bullish case scenario, we'll assume that we are going to exit the bull flag and move upwards. So there are two possibilities. One possibility is that tomorrow we'll bounce off this the support line for the bull flag, and we'll start moving towards the resistance. The other possibility is that we may bounce off the support at 12,168.25, which is this horizontal line of support. And our first resistance in that case is going to be the 10-day simple moving average, which is this yellow line that we see here. It's sitting at 12,492.83. So NASDAQ would behave that way if it was a bullish case scenario. And let us go and have a look at what QQQ would look like in that case. In QQQ, if we were to assume a bullish case, then we are looking at QQQ jumping off this diagonal line of support of the bull flag, or from the horizontal line of support, which is at 296.99, this fluorescent blue line. If you recollect, this was the blue line which was a resistance for our consolidation channel all the way from 14th of September onwards. So it's a very, very strong line of support. So we are expecting that the second stop would be that one, and that will push us forward upwards. So with that said, let us look at S&P 500. The bull case for S&P 500 seems to be even better, because we are at the confluence of the support channel for the bull flag and the support channel for the bull channel. So support line for the bull channel. So it's a very, very strong support out here, and we are expected to bounce off this here. Now I just want to go back quickly to QQQ and show you that there is indecision in the market. There is this doji candle. We can assume the doji candles to show an indecision that people are considering this theory as well, and they are not so sure anymore that that the CPI is going to be stubborn. That's one way to read it. And then if we were to go to Russell Index is also on a strong support out here at 189.01, and it could potentially bounce off from here. And Dow Jones Industrial Average is on a bullish pennant because the pennant is formed on a upward trend. So it's a bullish pennant, and a bullish pennant usually more often than not allows for a breakout on the upside. So we could expect this to go and a breakout on the upper side. Now let us look at the VIX. VIX has got an inverted hammer. This is a bearish inverted red hammer. This is a bearish sign, and it's being constrained by the 50-day simple moving average, which is this thick orange line out here, and it's sitting at 20.72. We need the VIX to be under 20 for good times, and I'm thinking that tomorrow it will definitely come under 20, assuming a bull case, and 19.75 being the support. So we want to see it fall below the 19.75 and consolidate somewhere out there. However, the one thing that does not support this thesis is the US dollar index, because the US dollar index is still pretty bullish in the charts out here. And friends, as you know, when the US dollar index becomes bullish and strong, it sucks in money from all other places. And as US interest rate goes up, a lot of money will come into the US dollar index. So that's the only contrary sign that I see here. Well, friends, that's all I have for you for today. Please let me know what you think about this. And the article is from a website called marketbeat.com. So check out that website. It's a great website. It's a great resource. And this article is really pretty good. But the conclusions of Fed chairman and these interest swap guys, it's so divergent that somebody is making a mistake somewhere, and we'll soon find out, because we are looking at just the month of June as for the inflation to fall. So in a matter of a couple of months, we'll get a clear idea of what's going to happen. With that, friends, I'd like to bring this video to an end, and I hope you have a great week ahead and you have a great day at work. Bye for now.